Okay, let's remind ourselves what we did in chapter 10 last time. We set up the standards. Standards for the two variables of the cost, quantity and the price per unit. Quantity, we already set up the standard that the quantity will be the exactly input that we need to use one product, and the cost will be the amount that should be paid for that particular unit which we're using to produce the product, which input that we're using. We found out that if we have to do the analysis start first with the report. Second, identifying variances, analyzing the variances, identifying questions, waiting to get the explanation or receive answers to our questions, then take the corrective action, and implement everything in the forthcoming period, run the report again, start comparison again. We already know that since we have direct material, direct labor, variable overhead, manufacturing overhead, we're going to split it by two. The variable overhead is fixed overhead. We're going to have standards for the direct material, which will be standard for the unit price and standard for the quantity. For the labor, we're going to have the standard for the hourly rate and standard for the hours. For the variable overhead, we're going to have the price standard and quantity standard, which will be based on the allocation base that we're going to use to allocate the variable overhead. And we find out that for the materials, when the price changes from standard to the actual, we're going to have material price variance. When the quantity changes between the standard quantity that we're supposed to use to produce our products versus the actual quantity that we're using to produce our products, we're going to have the material quantity variance. For the labor, if the standard rate change in comparison to the actual rate, we're going to have the labor rate variance. On the quantity variance, if the amount of hours change based on the what we're supposed to do or produce hours that we need to use to produce the production based on our standards versus the actual amount of hours that we used to produce the actual units of production. If there's a changes, that we'll call labor efficiency variance. For the overhead, again, we're going to have the spending variance for the rate change and efficiency variance for the allocation base change. We already went through the examples with the direct material and calculation of the direct material variances, identifying who is responsible for production manager responsible for the material variance, the purchasing manager responsible for the price variance. Then we went to the labor variances, and we saw that for the labor variance, only the production manager is responsible. Then we went to the variable overhead variances. We identified the variances, we explained the variances. And for the variances on the overhead, we're not going to keep anyone responsible. That was for the manufacturing company that has a product, which product has the direct material cost, direct labor cost, manufacturing overhead, and more specifically, variable manufacturing overhead. Now, what we're going to do with the company, which is in the service industry. Same. The only thing that will be, to some extent, a little bit different will be the materials. In the materials, we may have more like a merchandising material or materials that we're purchasing and selling or using in the service or just directly giving to the client. But for the hours and the variable overhead, it will be exactly the same. Now let's see what we're going to do with the fixed overhead. Don't forget the variable overhead has manufacturing overhead has two components, and we break it by two, the variable portion and the fixed portion. But all together, they're representing our variable manufacturing overhead. So the question is how we come up with the manufacturing overhead. If you still remember on the job costing, which was chapter 5, on chapter 5 we have the problem with the manufacturing overhead. How are we going to allocate manufacturing overhead when manufacturing overhead combine so many different costs which coming from the different period of the operating cycle of the company? And we decide that we're going to have a predetermined overhead rate. For the predetermined overhead rate, we're going to assign it based on the activity that we have. But in order to do that, first we have to estimate and come up with the estimation for predetermined overhead rate. And for the predetermined overhead rate, what we decided to do was to estimate our total cost for the upcoming period, which in this case will be easily saying that that will be our budget number. And as a denominator, we're going to choose the denominator level of activity, which we're going to be estimate as well. So now once we have that, the key here is the denominator activity. The denominator activity is the figure which is used to compute the predetermined overhead rate. Once we estimate the activity level or denominator activity, it remains unchanged through the entire year. So we're not changing predetermined manufacturing overhead through the period until the period is over. Then we can do some new calculation, new adjustments if it's necessary. So predetermined overhead rate is going to have two components. One will behave as a variable, the other will behave as a fixed. Variable component always going to be used to preparing and analyzing the variable overhead variances, where the fixed component will be used to preparing and analyzing the fixed overhead variances. We already saw how we're going to deal with variable overhead variances, and we know that we have the rate variance and efficiency variance. For the fixed overhead, we have to go a little bit deep. To understand the fixed overhead variance, it's important for you to understand how the overhead is applied to the working process in the standard costing system. In the standard costing system, which using predetermined overhead rate and applying based on the actual usage of the allocation base, we have two options under that standard costing system. One option is the normal costing system. Now you're going to say, oh my God, that's become too complex. Yes, it is. In reality, it is complex. So let's see what the normal costing system will represent. Under the standard costing system, we're going to have normal costing, and then we're going to have standard costing system. So the normal costing system, overhead is applied to the working process account based on the actual number of the hours which are work on the period. So if the hours is our allocation base based on the number of hours that was actually work in the period, and applying the variable manufacturing overhead rate. Now in the standard costing system, overhead will be applied to the working process based on now on the not on the actual number of hours, but on the standard hours which are allowed for the actual output for the period. So that will be a little slightly different, as you can see. So that's how we're going to have one component on the right side, which is going to have the actual cost versus on the left side, which is going to have standard cost. So again, on the normal costing system, we're going to have on the manufacturing overhead account, when we look at the manufacturing overhead, we're going to see the actual on the debit side. On the credit side, we're going to apply the manufacturing overhead cost by using the actual hours that workers work, if we're using direct labor hour, time the predetermined manufacturing overhead. Now the standard costing system, non-debit is still going to be actual, no changes there. Predetermined overhead is going to be the same, but how we're going to apply that cost will be a little bit different. We're not going to use the actual hours. We're going to use the actual input time the standard hours which are allowed to achieve that actual input. And that's how we're going to have the variances. So the first variance will be called budget variance. Budget variance is going to tell us simply is the amount that we budgeted for fixed overhead actually happen, or we spend more or spend less. And the volume variance will be the interesting part. Now, on the actual fixed cost, there will be no formula here because that's a fixed cost. Once we see the cost, that's what it is. On the fixed overhead budget, when we're doing the fixed overhead budget, we're going to have the standard fixed overhead rate times the denominator hours. Which denominator hours? The one that we use for our calculation of predetermined manufacturing overhead. On the standards, we're not going to work with the denominator hours. We're going to use the standard hours which are allowed for the activity that we have times the standard rate. Now, again, fixed overhead variances will be the budget variance and the volume variance. Budget variance, again, is going to measure difference between the actual overhead applied as a cost during the period versus the budget fixed overhead cost as a number again. Volume variance will be the interesting part. Volume variance is going to tell us how well we utilizing the available capacity that we have as a which we're using to measure our allocation base for the denominator on the predetermined manufacturing overhead formula. What we need to know first, don't forget, we have variable cost and we have fixed cost. Fixed cost in total never changes if it stays with the relevant range. Variable cost per unit never changes within the relevant range. Variable cost in total increase based on the usage. Fixed overhead rate per unit goes down as we using more of the capacity that we have available. That's where the savings gonna start coming. So now in this situation, we can easily calculate that the variable overhead rate per 1 unit is 6 divided by 3, 2. 8 divided by 4, 2. Fixed overhead will be 9 divided by 3, $3. 3 divided by 4 will be less than $3. How exactly it's going to be? So the variable overhead always going to be per unit, always going to stay the same. Fixed overhead per unit is going to start going down. Why? Because we're utilizing it by using more machine hours in this case. No, we're not just producing more units, just using more machine hours. So the total predetermined overhead always going to be some of those numbers. So now this company, they calculated predetermined overhead rate based on the 3,000 machine hours. So when they're using for 3,000 machine hours, we can see the numbers. Variable overhead per unit is $2. Fixed overhead per unit is $3. That's where we stay. So now, the company production required 3,200 standard machine hours. Actual fixed overhead was 8,450, and the predetermined overhead rate is based on the 3,000 machine hours, means that fixed overhead per unit is $3. If we have to do the calculation, we already know that we budget at the level of 3,000 machine hours, our total fixed overhead is supposed to be $9,000. In reality, went down with $550, and that's purely budget variance. That's we spending less on the fixed overhead cost compared to what we budgeted. Now let's see the next variance, which is the volume variance. Now we know from the formula or from the reality that we stop that $9,000 comes because we supposed to use the 3,000 machine hours and the fixed overhead rate is $3. Based on our standards, however, we have available 3,200 standard machine hours. That's our actual production required 3,200 standard machine hours. So once we compare that number, 3,200 times $3, it's going to give us that we have capacity and our fixed overhead can go up to $9,600. In reality, we budgeted less on the 3,000. Why? Because we're not using the standard hours which are allowed to our production. We're using only 3,000 hours. So we are not utilizing the hours that we have available. For that reason, we have the volume variance, which in this case is favorable, of $600. In overall, we have 1,150 favorable variance for the fixed overhead. So now let's think about it. Volume variance. What is the volume variance? Volume variance gonna result when the standard hours, which are allowed for the actual input, differ from the denominator activity. So what that means? In our calculation here, as you can see, based on our standards, we have the capacity of 3,200 hours. But we budgeted our fixed overhead based on only 3,000 machine hours. So we are below our capacity. So what that means in this formula, as long as the fixed overhead budget, including less hours than our standards, we are always going to have the favorable variance. The only way we to have on the volume variance unfavorable variance when we use more of the capacity that we have. So again, when the standard hours are less than the denominator hours, which are used to calculate our budget, then we're going to have unfavorable variance. When the standard hours are more than denominator hours, which are used to calculate our budget, we're going to have favorable variance, which is in our case. We have a favorable variance because we're not utilizing the 3,200 hours that we have. We're using only 3,000 hours. So the volume variance. For the volume variance that's the only variance that doesn't measure overspending or underspending. It's just treated overhead as a variable cost. We to understand how well we utilizing our capacity. So let's do this question quickly. The actual production for the period required 2,100 standard direct labor hours. The actual fixed overhead for the period was 14,800. The budget fixed overhead was 14,400. Predetermined fixed overhead rate was $7. what is the budget? What was the budget variance? Now the budget variance, don't forget the budget variance is the difference between the fixed overhead budget versus the actual overhead. And as we can see, we have the actual overhead was 14,800, but the budget fixed overhead was 14,450. So if we have to substitute here, let me see. Oh yeah, it's gonna let me do it. So if I have to substitute here in this chart, what we're gonna have in this case, 14,800 from here will be my actual, and my budget will be 14,450. And that's going to give me unfavorable this case. Unfavorable budget variance of $350. Why? Because the actual overhead that I'm using is actually above the overhead that I budget to use. Now let's see what's going to happen on the other side. With this other side, we calculating that the standard direct labor hours are 2,100, and our predetermined overhead rate per direct labor hours was $7. And that's going to give us cost of 21 7 times, correct? Which will be transferred to $14,700. So we have our volume variance, which volume variance in this case is, as you can see, the volume variance will show that we looks like we saving cost, but in this case gonna simply show us that we're not using the standard hours that we have available. We are below those standard hours, or $250 favorable. So the overall variance will be $100 unfavorable, as you can see. So now in our question, again, the first one will be the budget variance, 350 unfavorable. Next one will be what's the volume variance? And for volume variance, we already calculated 250 favorable. That will be the explanation of the chart that we just created. So in reality, our budget fixed overhead is $9,000. And that's when we achieve 3,000 hours of activity, which will be the denominator activity. That's how we're supposed to apply the overhead to our products. In reality, the favorable is, as you remember from here, we have a reduction on the fixed overhead to 840, 450, 8,450. That's going to tell us that we are below the budget. So we have capacity to go up, but we didn't. We're saving. And our standards, the standard hours that we have, are way more than the expected level of activity. we have 3,200 standard hours. So our capacity of our machine is 3,200. Let's pretend that we're on production. Imagine this. You have production cycle, which you're producing, let's say what you're producing. You're a printing company. You know that capacity of the machines that you have available, every machine comes with speed characteristics, and you know that every if we have different product, the normal capacity of each machine based on the standards of the machine and the machine is set up. Let's say I can print maximum 10,000 pages per hour. Now, you know, based on the historical uh, information that you have about the business, that per hour you're usually printing between 5,000 and 6,000 pages. So when you're making your budget, you may go with the 6,000 pages, but that's right there give you available capacity of 4,000 pages, which you're not using. Now, when you start printing, you actually didn't print, your printing volume is not 6,000 pages, it's even 5,000 pages. Obviously, the cost is going to look lower, but the fact is that you're not using the capacity that you're paying for. It may look like a cost savings, but in reality is lost opportunity to generate more profit. So in the standard cost system, unfavorable variance will be equivalent for the under apply overhead. So you have the capacity, but you're not applying it. So you're going below the actual available. Favorable variance will be overhead was over applied. Remember, if there's over applied, under applied overhead, that has to be closed at the end of the period. Now, every time when we have this, that was the fixed overhead. The fixed overhead, the only thing that I want you to understand is that the fixed overhead tells you how much is the capacity that you're actually using compared to what you have available. The other example will be, if you want practical example for the fixed overhead variance, I can give you the fixed overhead example. Example will be, that's something that you're not paying because you're Douglas students. I believe for the Douglas students, the price of the monthly fee for the SkyTrain is included. So you're getting it kind of free, but you're still paying it. But let's pretend that you have to pay outside. You pretend that you have to pay for the choose zone fare, and you're paying monthly fee. So based on the monthly fee that you're paying and based on the standard ticket price for two zones on the regular hours, no, we're not talking about after 6:30 and on the weekends, you need to pay certain amount of money. So you can easily calculate based on the amount that you're paying, how many trips you have in your monthly pass. Once you achieve that many trips, that means you utilize the cost that you already pay as a monthly fee. Now, what's going to happen if you use less trips? Seems like it's a cost savings, but you cannot save on the fixed cost because you already pay for it. So what happens in reality, you're using the less. So you're not reaching the standard that you have, standard trip that you have within the capacity of the monthly pass of the Compass card. That's what simply the fixed overhead uh, variances is about and volume variance is about. The volume variance will be only and only related to the usage of the available capacity that you have or the company has in terms of the fixed cost. Now let's go with the performance report and how we're going to do those performance reports. In order to do the analysis for the direct material, direct labor, variable overhead, and the fixed overhead, we have to prepare reports. After preparation of the reports, management still has to decide whether the variances are calculated required for the action. Variances, sometimes they might not worth investigation. If you already know what's happened during the period, you already have the answer and you're expecting those variances. If you see something that you haven't expect or didn't expect, then you can go and investigate further. Management should consider the dollar amount of the variance and size of the variances relative to the amount of the spending which is involved. And another approach is the plot variance data on the statistical control chart, which example you're going to see here. So if the zero level, no variance is right here, then we're going to see some standard, we're going to give some standard deviation from the level of no variance. And based on that deviation, if the normal deviation is above the standard deviation, then we're going to investigate the numbers. Which brings us to the point what kind of capacities we have, and we have two types of capacity, theoretical capacity and practical capacity. Theoretical capacity always going to be the volume of the capacity if all available production time is used and no waste happen. So my theoretical capacity, it can be 83 years or 81 years based on the Statistic Canada for the life expectancy for a person like me. The practical capacity will represent what could be produced with the operation at the theoretical capacity, less unavoidable downtime. So, the practical capacity for me will be the number of years which my mind is going to stay intact so I can deliver lectures to the students. That will be my practical capacity. As you can see, the practical capacity is not going to be equal to theoretical capacity. It's going to be less than theoretical capacity. Advantages of the standard costing is management by exception. Why? Because again, we're chasing the variances, we're identifying the variances, we're asking questions, we're waiting for the explanation, implementing the changes, and see the results. Promotes economy and efficiency. More you understand about the processes in the company, better you can be on the efficiency and how using the resources. Obviously, it's going to simplify the bookkeeping and the enhanced responsibility accounting as well. For the potential problem with the standard costing, it's going to take time for the standard costing reports to be prepared. We can focus too much on the negative, and that can destroy the morale in the company. If we make some invalid or incorrect assumptions, we may lose the idea of the variances. So for that reason, we have to be very careful on the assumptions if we're doing assumptions. That's why I told you, don't make assumptions. Identify questions, look for the answers, then make decisions. Favorable variance may be misinterpreted the way we saw with the direct material. We see favorable variance on the price, but that favorable variance is actually the reason why we overspending money. So that's perfect example of how the cheap things tends to be more costly. Emphasizing standards may exclude other important objectives. So if we only focus on the standards, we may forget about other factors. And continuous improvement is important in order to meet the standards. Now, for the further analysis of the material variances, for those of you who's going to go with the accounting, they're going to see that furthermore, on the material variance, we can go deeper on the quantity variance. And we can identify from where the quantity variance is coming from. If we have more than one product or more than one ingredients to produce the product. Is it because of the mix of the variance or yield variance? And those people, they're going to find out more about it and more for more, of course. For the general entries, I'm not going to spend time on the general entries. That's not the point of this course. That will conclude chapter 10 and our discussion for the fixed manufacturing overhead variance